Currency markets are moving to a new rhythm and breaking from the usual script. Central banks and bond markets are now setting the tone and reshaping long-standing correlations. Across markets, short-term prints are taking a backseat, while central policy and rate expectations are firmly in the driver's seat. I'm Johanna Bota, and joining us today is Global Head of Retail Dealing, Alex Richards. Alex, thank you for being here with us today.
Hello there.
Alex, let's start with recent events. What are they doing to FX markets? What is different this time?
Well, normally when we talk about which currencies traders are buying, when traders are confident, we see emerging market currencies being bought and real strength there. And then quite the opposite, when there's a flight to safety in terms of times of recession, we see the major currencies, which of course is particularly the dollar, all money's going there, the dollar strengthening. Whereas now we're seeing something quite unique that in my time in the city we haven't seen before, where we've almost got the middle being squeezed. The dollar is weak and emerging markets are weak, which, as I said, is unprecedented. So we've got the euro, Swiss, and yen, and to a lesser extent the pound, all being squeezed up in the middle.
So do you think that this is the end of the US as the world's currency?
Well, it's funny, there's a lot of articles at the moment about that, but it's firmly a no. I mean, I think there's still 88% of all FX volume goes through the dollar pair. So any thought of it being not the reserve currency is short-lived.
There's been a lot of talk about bond markets recently. So what's the link between FX and bonds?
Well, bonds is a very complicated world that I won't get into too much depth in, but as a general rule of thumb, the strength of the dollar is driven by dollar yields. Again, the more interest you're being paid on a currency, the more advantageous it is to hold, and particularly with T-bonds, high rates on T-bonds, all these there's a global influx coming into the dollar to be purchasing those assets. And again, as we're saying, things have changed, that there's only 3 times since the 1970s that we've actually seen a rise in yields across the board, right, more in the longer term, but we've seen sort of more than a quarter base or 25 basis point rise in interest rate expectations. Yet we've seen a 2.5% drop in the dollar. And the only 2 times we've seen that previously, so since the 1970s, we've then seen a significant drop in the dollar post that.
So what does this mean for the yen and the dollar yen in particular then?
Well, since the major events of the start of April, we've seen a real retracement in dollar yen back to sort of the low 140s, whereas, I mean, I think a few months ago we were up as high as 160. So, I mean, this is partly as part of the yen being seen as a safe haven, but also, again, showing the dollar's lack of strength. But actually, when we're talking about the bigger picture for dollar yen, 142 really seems like a major drop, but in long-term history trends, we're still very high. So we're almost at a very interesting point where we're coming down to last year's lows, but there's a big gap. And I think this is where the technical traders will be looking into this. There's a big gap below 140. I mean, thinking back to as far as 2023, we were at 128, and a year before, 2022. I mean, it seems like a long time ago, but it really isn't. We were back down at 113. So there were this sort of borderline. Well, do we push down to and really break a new level, or is there going to be something that's going to steady the dollar that we're not aware of at the moment?
Well, how do retail investors play these events then?
Well, usually we find the typical retail investor, they like markets returning to where they started. So we'd call it counter trending. So there's again, was saying, when you look at the graph coming down from 160 to 142, many traders, and I'm sure not just retail, but many institutional traders will be thinking, well, this is a great point to buy. And I think this is almost why it's that idea for retail traders to say, whatever positions you want to take, do it, but be a little bit cautious, because there is a significant gap that could be happening on the downside.
And you could buy the dip, but then it could just keep going lower.
Well, this is it, isn't it? I think often when you're counter trending, you counter trend for a small move. The market's gone down, and again, when markets are oscillating, just a little bit up, a little bit down, almost like a sine wave, that's exactly where you're taking those small moves. But sometimes, again, that idea of buying the dips, sometimes it's sell at the bottom, because there could be a bigger move to come.
So what's the European outlook then?
Well, I think in terms of Europe, Switzerland seems the most interesting, where we're now talking about levels of dollar Swiss that we haven't seen since the Swiss National Bank sort of crash of 2015 or so, when strength in the Swiss franc, but crash in dollar Swiss. So being in such sort of rarefied air down here, there could be in the same way as yen, an idea, a trading idea to say, well, actually, it's going to go a lot further. But at the same time, we're almost getting to this. There's a lot of similarities between the dollar and the Swiss franc. That with the dollar, we're waiting to see what what Donald Trump is going to do next, and again, what's going to happen on that side. So again, with all these policies, there's a chance they'll all be undone. We'll go back up. Everything will return. And the same with the strength in the Swiss, where there is this almost permanent Swiss strength recently. But what if the Swiss National Bank again says, wait a minute, the Swiss franc is way too strong. We're going to be starting to sell this. So it's almost like the trend is going to continue until something changes, which of course could be at any time.
Be very soon.
Yeah, and say that, and that's what the interesting thing is, that this is not just for the dollar, but for the Swiss. So there's the same play on both currencies merged into one currency pair.
So then what should we be looking out for? I mean, because everything is changing. So what is the difference now? What should we be looking for that's different?
Well, I suppose most of the time, day traders they're looking at what's happening day to day, the market data coming out, or the news data. So we're talking about US retail sales, consumer price inflation, non-farm payrolls. And they're still going to drive the markets in the short term. But I think what we're going to see again is they're the short-term moves, but the bigger moves are driven by the central bankers. I mean, it's like the central bankers are now the rock stars that are really going to be driving the world, rather than companies making money and company profitability. So that combined with bond yields is the sort of the new normal, if you sort of mean. So we're away from how well a company's doing, how's Apple doing, how's Tesla, etc., to what's on the other side, which is almost like the darker, murkier world. And I think there's a strategy that's always sort of played out well for me as a trader over the years. If you can look at a move and explain it, almost to see, right, why has this gone up? You go, okay, there it is, bang in the news. This is why it's gone up. I've always got to say, right, that's played out, go against it. It's the moves that are happening, and you look and you can't see why they're happening, and they're the ones you want to be fearful for.
That is quite scary to think about. Thank you, Alex. And thank you for watching. For more financial content, please like and subscribe to our channel.